staring at a really complex corporate structure, a web of parent companies, subsidiaries, 80% holdings, shared board members, and having absolutely no idea what the true financial reality of the business actually is.
Yeah, it's a total nightmare.
It really is. You're looking at a spreadsheet and asking yourself, like, are they actually making money or just, shuffling it around?
Right, exactly.
And here is the ultimate puzzle for you. Why does owning less than half of a company's shares sometimes give you total absolute control, while owning the vast majority of non-voting shares gives you exactly zero control? The answer to that changes, well, everything about how a business reports its wealth.
It completely flips the narrative, yeah. From a financial perspective, anyway.
Welcome to the Deep Dive. Today we are covering the FAFA syllabus topic on consolidated financial statements. We're going to break this down into 3 parts. Look at a very concrete, real-world example of how this works in practice, and finish with 3 exam tips you can use immediately.
It's great to be here. And, this is one of those topics that seems incredibly dense when you first look at the source material.
Oh, yeah.
But once you see the underlying logic, like the why behind the rules, it all clicks into place beautifully.
Okay, let's unpack this, because the sources throw a lot of acronyms at us, IAS 27, IAS 28, IFRS 3.
Old favorites.
Right. So let's sweep the jargon aside for a second and start with the absolute foundation. What are we actually talking about here? Like, what is it really?
Well, the absolute simplest definition, and this is a maximum of maybe 2 sentences, comes directly from IAS 27.
Okay.
It defines consolidated financial statements as the financial statements of a group presented as those of a single economic entity.
A single economic entity. Okay, think of it like a family applying for a joint bank loan. Even if the parents and the older kids have their own separate bank accounts, the separate wallets or, separate side hustles, the bank doesn't really care about how they transfer money internally to pay for groceries.
No, they don't.
The bank wants to see the combined household income and debt as one single unit to understand the family's total purchasing power in the outside world.
That is exactly the right lens to view this through. You're drawing a boundary around the whole family. And here's where it gets incredibly interesting. And frankly, what surprises a lot of people when they first look at the corporate version of this.
Okay, hit me.
You can legally control a subsidiary, meaning you treat their entire financial statement as your own, even if you own less than 50% of the voting shares.
Wait, really? How does that work? If I own like 40% of the shares, the other 60% can just outvote me. How is that control?
Because of the board of directors. Provided you have the power to appoint the majority of the board of directors, you have control.
Oh, wow.
Yeah, IFRS 10 lays out 3 conditions for this: power over the investee, exposure or rights to variable returns, and the ability to use your power to affect those returns. If you appoint the board, you dictate the strategy, the dividends, the hiring. You have the power, regardless of the share percentage.
That is fascinating. So this entire concept is really about mapping out financial boundaries based on who actually calls the shots, and then merging those entities into one unified picture.
Precisely. You're capturing the economic reality, not just the legal structure.
Which brings us to the obvious question. Why do examiners obsess over this topic so much? I mean, it feels like it's everywhere in the syllabus.
Well, if we connect this to the bigger picture, like the real business world, you have to understand that companies constantly trade with each other.
Sure.
If you're a massive conglomerate, your manufacturing arm is selling to your distribution arm, which is selling to your retail arm.
Right.
Without the rules of consolidation, a parent company could artificially inflate its revenue by endlessly selling inventory to its own subsidiary at a markup. They could book massive sales on paper, but no actual new money has entered the group from the outside.
Ah, right. You're just moving money from your left pocket to your right pocket and telling the world you got a raise. It's a total illusion.
Exactly. It would make financial statements completely useless for investors. So there are 2 major reasons examiners love testing this. Here's the first. Examiners want to test if you understand the fundamental difference between control and ownership percentage when combining these assets.
Right. They want to see if you can identify who is actually running the show.
Exactly. And the second reason, they love testing if you can spot and eliminate that hidden intergroup trading. They want to see if you have The analytical X-ray vision to look past the internal web of transactions and report the true economic reality to the outside world.
Well, that, and because examiners thrive on our collective suffering when we accidentally double count inventory.
It definitely feels that way when you're staring at a spreadsheet at midnight. But it really is about protecting the integrity of the financial markets.
Okay, so there are three parts to this. Let's take them one at a time. The first part is identifying the relationship between the companies. We've thrown around terms like subsidiary and associate, but how do we actually tell them apart when we're looking at a group structure?
It all comes down to the level of influence, which dictates the accounting treatment. Let's look at the Greenco illustration from our source material.
Okay, Greenco.
Greenco owns 80% of the equity shares in a company called Violet Co. That is clearly more than 50% of the voting power, so Violet Co. is a subsidiary. Control exists.
Right, that's the easy one. If you own 80%, you're the boss.
Yeah.
Simply put, control means you combine their assets line by line into your own financial statements.
Correct. But then the source introduces a company called Amber Co. Greenco owns 25% of the equity shares and 80% of the non-equity shares.
Oh, I see where this is going. That's a classic trap. Non-equity shares, like preference shares, usually don't give you voting rights. They just give you a right to a fixed dividend.
Precisely. So despite owning 80% of those non-equity shares, Greenco only has 25% of the voting power. They do not have control.
So Amberco is not a subsidiary.
Right. But the best example in the source is Blackco.
Oh?
Greenco only owns 45% of the equity shares in Blackco. Less than half.
So no control?
You would think so. But the case notes that Greenco has appointed 5 of the 7 directors of Blackco. Because they control the board, they control the company's decisions. Therefore, Blackco is a subsidiary and must be consolidated line by line.
And what about that 25% voting power in Amberco? What does that make them?
That level of influence, specifically called significant influence, is what defines an associate under IAS 28. Usually that falls in the 20 to 50% voting share range.
Got it.
For an associate, you don't combine their assets line by line. You use the equity method, meaning you just bring in your share of their net assets and profits as a single line item.
Okay, so if we've successfully mapped out who we control and combine these companies into one giant entity, that leads us perfectly into the next problem. What happens if the parent was charging the subsidiary for something?
Yeah, that happens a lot.
But you can't owe yourself money. So how does the accountant fix that? Let's move to part 2, the elimination of intergroup balances.
Let's use the Pink Co. and Scarlet Co. example from the text to visualize this. Pink Co. acquired 80% of Scarlet Co. So subsidiary status is established.
Right.
At year end, Pink Co.'s receivables, the money people owe them, show an amount due from Scarlet Co. of $4,600. The subsidiary owes the parent money for some internal transaction.
But if we just said they are a single economic entity, then borrowing from your subsidiary is like, well, it's like my left hand borrowing from my right hand.
Exactly. You must eliminate it. Let's say Pink Co.'s total receivables from everyone in the world are $50,000, and Scarlet Co.'s are $30,000. Pink Co.'s payables, what they owe to the world, are $70,000, and Scarlet Co.'s are $42,000.
Okay, a lot of numbers.
To find the consolidated receivables, you don't just blindly add $50,000, $30,000 to get $80,000.
Because that $80,000 includes the $4,600 they owe themselves.
Right. You have to subtract that $4,600 intergroup IOU. The correct consolidated receivables figure is $75,400. And you do the exact same subtraction for the payables, because Scarlet Co.'s payables include that same $4,600 owed to Pink Co. You just wipe it out entirely.
Wiping out internal IOUs makes total sense, but that raises a much trickier scenario. What happens when you've sold goods to your subsidiary for a profit, and those goods are just sitting in a warehouse, completely unsold to the outside world?
That is the big one. And it brings us to part 3, adjustments for unrealized profits, or as the syllabus calls it, PUP, provision for unrealized profit.
Okay, before we throw numbers around, let's translate this into the real world. If I buy a brand new laptop for $400 and I sell it to my teenage son for $500, our family hasn't actually made $100.
No, you haven't.
The laptop is just sitting in his bedroom. I can't claim our overall family unit is richer until he takes that laptop and sells it to a stranger on eBay for $500. Until then, that profit is entirely imaginary.
That is a brilliant way to frame it. Until inventory is sold to a non-group entity, any internal profit is unrealized. You must eliminate the intragroup sale from your revenue and then adjust the cost of sales and inventory to remove that imaginary profit.
Hold on, let me write this down mentally. Let's run the numbers on this using the sources Purple Co. and Silver Co. example. Walk me through it slowly.
Okay. Purple Co. acquired 70% of Silver Co. Purple Co. has total revenue of $79,300. Silver Co. has total revenue of $29,900. During the year, Purple Co. sold $5,000 worth of goods to Silver Co.
Stop right there. The very first step, regardless of what is left in the warehouse, is to eliminate that $5,000 internal sale, right? Because they just sold it to themselves.
Yes. We take Purple Co.'s $79,300, add Silver Co.'s $29,900, and subtract the $5,000 intergroup sale. The consolidated revenue is $104,200.
Got it. But what about the imaginary profit on those goods?
The source notes that Purple Co. originally bought those goods for $4,000. So they made a $1,000 profit selling them to their subsidiary for $5,000. And here is the kicker. Half of those items remained in Silver Co.'s inventory at year-end.
They haven't been sold to the outside world.
Exactly.
So if half the items are still there in the warehouse, half the profit is still trapped in the group's inventory. That's $500 of unrealized profit.
Exactly. The group is effectively overstating its inventory by $500, pretending it made a profit by trading with itself. The accounting journal entry to fix this is to debit, meaning add back $500 to cost of sales, which reduces your overall profit, and credit or reduce inventory by $500 on the balance sheet.
So to bring that all together, to build an accurate consolidated statement, you define your group by who you control, you cancel out any internal debts, and you erase any imaginary profits you made by trading with yourself.
That is the perfect synthesis. You're stripping away the internal noise to find the objective external truth.
Now, let's ground this even further. We've talked about assets and inventory, but what about the premium a company pays when they acquire another company?
Oh, yeah.
I want to look at a highly visible, global, real-world concept, goodwill. Every time a massive tech company buys a startup for billions of dollars, we hear about goodwill. What actually is it?
Goodwill is a massive part of the FAA syllabus, specifically under IFRS 3. In the real world, it represents the intangible value of a business that isn't physical. It's brand loyalty, an incredible customer list, human capital, or, a secret recipe.
Right.
In accounting terms, it's basically the difference between what you paid to acquire a business and what if raw physical net assets are actually worth.
Let's walk through the Redco and Blueco scenario from our sources. Redco acquires 80% of Blueco's 40,000 ordinary shares on January 1st for a consideration of $3.50 cash per share. How do we build the goodwill calculation? Let's take it one step at a time.
Okay, step one. Let's calculate the consideration transferred, what Redco actually paid. Redco didn't buy all 40,000 shares. They bought 80%.
Right, so 80% of 40,000 is 32,000 shares.
Exactly. Multiply those 32,000 shares by the $3.50 purchase price, and you get a consideration transferred of $112,000.
Let me pause you there, because whether you are taking an exam next week or building a financial model at your desk, this is crucial.
Yeah.
You have to calculate each of these components individually. You can't just jump to the end. So we start with our $112,000 purchase price. What's step two?
Step two involves the non-controlling interest, or NCI. This is the 20% of the company that Redco didn't buy. Even though they didn't buy it, we need to value the entire company to find the total goodwill. In this scenario, the source tells us the fair value of that 20% NCI slice is $30,000. We add that to our $112,000 consideration, giving us a total presumed value of $142,000 for the whole company.
Okay, so the total pie is worth $142,000, and the final piece of the puzzle.
Step three, we need the fair value of Blueco's actual identifiable net assets at acquisition, the desks, the servers, the inventory. The text gives us a clean figure of $125,000.
So we take our $142,000 total company value, subtract the $125,000 in actual hard assets, and we're left with $17,000 of, well, ghost money.
Exactly. That $17,000 is the goodwill at acquisition, the premium paid for the brand, the synergies, everything intangible.
Now, wait, time out. I need to push back on this because there's a massive conceptual leap here. You're telling me Redco only bought 80% of Blueco, but they get to claim 100% of Blueco's goodwill on their consolidated balance sheet.
I am.
If I'm an investor looking at Redco's financials, isn't that lying to me? They are claiming assets they don't legally own.
It sounds like a contradiction, I get that, but it's not lying. It goes back to that pure economic concept of control. Because Redco owns 80% and controls the board, they control the entire subsidiary.
Right.
They dictate how all the assets are used, including the goodwill. Therefore, IFRS 10 says they must recognize 100% of the assets.
But what about the 20% they don't own? How does the balance sheet balance?
That is where the non-controlling interest comes in. The fact that they only own 80% is accounted for on the other side of the balance sheet, under equity, through the non-controlling interest line item.
Oh, I see.
You show all the assets you control on the left, and on the right, you show exactly who else has a claim on a portion of those assets. It is completely transparent.
And that right there is exactly what the examiner is testing when they ask about calculating goodwill and measuring non-controlling interest under IFRS 3 and 10. They want to see if you understand that control overrides the exact ownership percentage, and that the balance sheet uses NCI to keep everything honest.
They absolutely do. Which leads us to the biggest pitfall in this entire topic.
What students get wrong?
The single most common mistake is prorating a subsidiary's statement of financial position when there is less than 100% ownership.
Give me an example. Let's go back to the Pink Co. and Scarlet Co. receivables. Pink Co. owned 80%. When we added their receivables together, we took 100% of Pink Co.'s $50,000 and 100% of Scarlet Co.'s $30,000 and then subtracted the IOU.
Yes. The trap in the multiple choice questions answer C in that specific illustration is calculating 100% of Pink Co., but only adding 80% of Scarlet Co.'s $30,000.
I totally get why people do that. Your brain naturally wants to match math to ownership. It feels incredibly logical to look at the prompt and say, I own 80%, so I should only report 80% of their cash and inventory.
It does feel logical, but it is fundamentally incorrect. Consolidated financial statements reflect control, not ownership. If you control the subsidiary, you control 100% of the asset.
Wow, okay.
You add 100% line by line. If you prorate those assets, you demonstrate to the examiner that you failed the core concept.
Your brain loves fractions, but IFRS 10 demands total domination.
That is certainly one way to memorize it.
Okay, we are rounding the final corner. It is time for your exam edge. 3 things you can use right away. Here is number 1.
Look beyond the equity percentage. The Indigo Co. illustration in the text is brilliant for this. They outline 3 investments. First, a 30% holding in non-voting preference shares in Yellow Co. Because they are non-voting, you have no influence. It is not an associate, despite that big 30% number.
Right. Ignore the big percentage if the voting power isn't there.
Exactly. Then look at their investment in Blue Co., an 18% shareholding. But Indigo Co. have 2 of the 5 seats on the board.
18%.
Yeah, that 18% looks too small to matter, but those board seats give them significant influence. So it is an associate and requires equity accounting.
And the final one, a 45% shareholding in Redco with 4 out of 6 board seats.
Again, less than 50% equity, but majority board control means it's a subsidiary. You must consolidate line by line. So tip number 1, always check the board seats and voting rights, not just the equity percentage.
Tip number 2, when dealing with provision for unrealized profit, or PUP, add it back to cost of sales to eliminate the profit. Do not incorrectly add it to revenue. In the Purple Co. example, the distractor answer had students adding the $500 PUP back onto the revenue figure.
Right. Yeah.
Don't do it. Revenue just gets reduced by the total intragroup sales amount.
That is a crucial distinction that trips up so many people. And tip number 3, read the requirement for goodwill carefully. Are they asking for the group's goodwill on acquisition, or are they asking for the parent's cost of investment?
That is sneaky.
It is. In our Redco example, the consideration transferred, the cash paid, was $112,000. If the question asks for the cost of investment in the parent's individual books, $112,000 is the answer. But if they ask for the consolidated goodwill on acquisition, the answer is the $17,000 we calculated earlier.
Right, so don't let distractor answers catch you because you calculated the right number for the wrong question. Always read the last sentence of the prompt twice.
Always. Always remember, consolidation is about presenting a group as a single economic entity based purely on who holds control, regardless of the precise ownership percentage.
For those of you taking an exam soon, take a breath, follow the steps logically, and don't let the distractor numbers panic you. The math itself is usually just addition and subtraction. It's the rules of engagement that they are testing.
And mastering this doesn't just help you pass an exam, it gives you the analytical X-ray vision to see the true financial reality of any corporate group in the world. It fundamentally changes how you read the news, how you evaluate investments, and how you understand global business.
That confusing maze of corporate structures we talked about at the start, it's not a maze anymore, it's a map.
Look for control and treat the group as a single economic entity.
Thank you to our global audience for joining us on this deep dive. Please follow us on Spotify and leave a review. It really helps us keep creating these deep dives for you. Keep diving deep. And next time you look at a massive corporate scandal in the news, think about this. If control is all about who absorbs the risks and returns, what happens when a company creates a special purpose entity specifically designed to hide toxic debt completely off the consolidated balance sheet? Where does the line of control really end? But that is a deep dive for another day. Thank you for listening.